You've got your first Canadian paycheck. Maybe your credit is building. Maybe you're even saving toward a home. But at some point, almost every new PR asks the same question: should I be doing more than just my job? Side income in Canada is completely legal and common, but the moment money starts coming in outside your paycheck, a new set of rules kicks in. Today we're covering exactly what those rules are, and whether you should stay a sole proprietor or eventually incorporate. Here's something that surprises a lot of newcomers. The moment you earn money outside of a regular paycheck, whether it's freelancing, selling on Etsy, driving for a delivery app, or consulting on the side, you are automatically considered self-employed. By default, this makes you what's called a sole proprietor. There's no separate legal entity between you and the business, which means it's simple to start, but it also means you're personally responsible for any debts or legal issues tied to that income. You don't need to file any paperwork to begin. You can start earning under your own name immediately. The only time registration becomes relevant is if you want to operate under a business name, or once your revenue crosses a certain threshold, which we'll get to. Once you're earning side income, 3 new responsibilities apply. First, income tax. You'll report this income using a form called the T2125, alongside your regular tax return. It gets added to your total income and taxed at your normal marginal rate. Second, CPP contributions. As an employee, your employer pays half your CPP automatically. As a self-employed person, you pay both halves yourself, roughly 11.9% of your net self-employment income in 2026. Third, GST or HST. If your total revenue from self-employment stays under $30,000 over 4 consecutive quarters, you don't need to register at all. Cross that threshold, and you're required to register, collect tax from your clients or customers, and remit it to the CRA. Here's the mistake that catches almost every new sole proprietor. There's no tax withheld automatically from self-employment income, the way there is from a paycheck. That means you need to set the money aside yourself. A safe rule of thumb is to move 25 to 30% of every payment you receive into a separate account the moment it lands, so it's already there when tax season, or quarterly installments, come around. If you expect to owe more than $3,000 in tax for the year from this income, the CRA may require quarterly installment payments rather than one lump sum in April. Setting money aside as you go makes this far less stressful. The upside of self-employment income is the deductions available to you, expenses that reduce how much tax you actually owe. If you work from home, you can deduct a portion of your rent, utilities, and internet based on how much of your space is used for business. If you use your car for client visits or deliveries, a portion of those costs are deductible too. Keep every receipt and track this consistently throughout the year, not just in April. Good records are what actually unlock these deductions and protect you if the CRA ever asks questions. Eventually, almost every growing side income leads to one big question: should you incorporate? Staying a sole proprietor is simpler and costs nothing extra. Your income is taxed at your personal rate, which can climb above 50% at higher income levels in provinces like Ontario. You're also personally liable for any business debts or legal claims. Incorporating creates a separate legal entity. Your corporation pays a much lower tax rate, around 12.2% in Ontario on the first $500,000 of active business income, compared to personal rates that can exceed 50%. The catch is added cost and complexity. Incorporation typically runs $310 to $3,300 to set up, plus $4,000 to $10,000 a year in accounting and filing costs. This only pays off if you're earning enough to leave a meaningful amount of money inside the corporation rather than taking it all out personally. For most new PRs in their first few years of side income, staying a sole proprietor is the simpler, more cost-effective choice, and you can always incorporate later once the numbers justify it. Beyond taxes, there's one more factor worth knowing: liability protection. As a sole proprietor, there's no legal separation between you and your business. If something goes wrong, a client dispute, an unpaid debt, a legal claim, your personal assets, including your home and savings, can be at risk. A corporation creates legal separation, which offers a layer of protection. It's not absolute, banks often still ask for personal guarantees on loans, and professional negligence can sometimes bypass that protection. But it's a real consideration if your work carries meaningful risk. To recap, any income outside your paycheck automatically makes you a sole proprietor. Set aside 25 to 30% of every payment for taxes. Track your deductions consistently, and only consider incorporating once your income consistently clears $80,000 to $100,000 a year and you can leave real money inside the business. Side income is one of the fastest ways to accelerate everything we've covered in this series: your savings, your down payment, your investments. Manage it the right way from day one, and it becomes a real asset, not a tax headache.